The U.S. stock markets are currently closed for the weekend. SoFi Technologies, trading under the ticker SOFI, finished Friday's session on September 26, 2025, at a closing price of $27.98. This represented a modest dip of about 0.5% on the day, a seemingly quiet end to a week that saw the stock navigating some choppy waters. But that closing print, that simple number, masks a far more complex and turbulent reality bubbling just beneath the surface. The common narrative paints SoFi as the undisputed future of banking, an all-in-one digital super app destined to topple the old guard. The expectation is a smooth, upward trajectory, mirroring the likes of early-stage tech behemoths. The reality, however, is that SoFi is now a federally regulated bank, facing the stiff headwinds of a volatile macroeconomic environment and intense competition, and its recent stock performance reflects this intense tug-of-war between a powerful story and a challenging operational landscape. Peeling back the layers of Friday's session reveals a telling story. The stock opened higher at $28.37 and even pushed to an intraday high of $28.48 before succumbing to selling pressure that dragged it down to $27.56. A trading volume of over 36 million shares tells us there was significant activity, not just passive coasting into the weekend. This price action is crucial. It suggests that for every buyer convinced of the long-term vision, there's a seller taking profits or hedging against near-term uncertainty. This isn't the straightforward buying frenzy one might see in a stock like Nvidia stock during a chip boom. This is a battlefield of competing convictions. This dynamic is visible across various platforms, from retail investors discussing their positions on the Robinhood app to the more sophisticated order flows seen on interactive brokers, which often hint at institutional maneuvering. The key takeaway from the recent daily swings is that SoFi has become a proxy for the broader debate on the future of finance, and its stock chart is the minute-by-minute transcript of that argument. Over the past month, the stock has actually shown considerable strength, posting a gain of nearly 14%. This outpaces the broader S&P 500, indicating that, despite the daily volatility, a bullish undercurrent persists. This strength has been fueled by a stream of positive analyst revisions and consistently strong quarterly results that have, so far, defied skeptics. The expectation is that as a disruptive fintech, SoFi should be immune to the woes of traditional banking. The reality is that by becoming a bank, SoFi has invited a whole new level of scrutiny and a direct correlation to macroeconomic pressures, particularly interest rate policy. Its primary revenue driver is still lending, personal loans, student loans, and home loans. This segment is exquisitely sensitive to the federal funds rate and consumer credit health. While the company has consistently beaten earnings estimates, much of the focus is now shifting to the quality of those earnings and the durability of its loan portfolio in a potential economic slowdown. Recent reports show that while revenue growth remains robust, with forecasts for the current fiscal year pointing to more than 30% increase year over year, the composition of that growth is what matters. Investors using tools from Fidelity Investments or those with Schwab Intelligent Portfolios are increasingly looking past the headline numbers and at the net interest margin, provision for credit losses, and the growth rate of its non-lending segments. The reality is that SoFi's fate is now intertwined with the credit cycle, a fact that the more simplistic tech disruptor narrative often overlooks. Institutional ownership provides another layer of this complex picture. Filings show that major institutions like Vanguard and BlackRock are the largest shareholders, lending a significant degree of stability and long-term conviction. However, the churn among other funds is noteworthy. In the most recent quarter, data indicates a fascinating mix of activity, with hundreds of firms increasing their positions while a nearly equal number decrease theirs. This isn't the uniform accumulation you might see in a successful stock story. It's a sign of a deeply polarized view among the so-called smart money attendants. Some are clearly buying into the long-term vision of a comprehensive financial ecosystem, while others may be trimming their exposure due to concerns about valuation or the aforementioned macroeconomic risks. For the average person managing their individual brokerage account, this institutional divergence is a critical signal that the path forward for SoFi is far from a foregone conclusion. It's not a simple story of up and to the right. It's a complex balancing act. So what does SoFi actually do?
It's crucial to understand the three core pillars of its business, as this is where the expectation of a simple app meets the reality of a multifaceted financial institution. First is the lending segment, the company's foundation. It started with refinancing student loans for high-earning graduates and has since expanded dramatically. The second, and perhaps strategically most important, is the technology platform, primarily Galileo. This is a payment processing and technology infrastructure provider that SoFi acquired, which serves a host of other fintech companies. It's a picks and shovels play on the entire sector, providing a source of high-margin, capital-light revenue. The third pillar is financial services, which includes SoFi Money, checking and savings, SoFi Invest, its brokerage platform, SoFi Credit Card, and other products. The grand vision is to create a flywheel effect, attract customers with one product, like a personal loan, and then cross-sell them into this entire ecosystem of services, increasing their lifetime value. The expectation is that this flywheel will spin effortlessly. The reality is that cross-selling is notoriously difficult, and competition is fierce for every single product line. SoFi isn't just competing against Chase and Bank of America, it's competing against Chime for checking accounts, Robinhood for stock trading, and 1,000 other digital-first companies. This brings us to the future outlook, where the tension between expectation and reality will ultimately resolve. The bull case is compelling. The national bank charter obtained in 2022 was a massive step. It allows SoFi to use its own member deposits to fund its loans, dramatically lowering its cost of capital compared to relying on wholesale funding markets. This is a structural advantage that many of its fintech peers lack. Continued growth in high-quality member acquisition, successful cross-selling that deepens customer relationships, and the expansion of the Galileo platform could lead to significant operating leverage and sustained profitability. Analysts forecasting strong earnings per share growth in the coming years are betting on this exact scenario. They see a path where SoFi's valuation, while currently rich, is justified by its superior growth profile compared to legacy banks and even other fintech players. However, the bear case is equally grounded in reality. The primary risk is a significant economic downturn. A recession would likely lead to a rise in loan delinquencies, forcing SoFi to increase its provision for credit losses, which would directly impact its bottom line. Secondly, the competitive landscape is not static. Big banks are improving their digital offerings, and well-funded fintech startups are constantly emerging. There is no guarantee that SoFi will win the war for the modern consumer's financial life. Finally, there's valuation risk. Trading at a high multiple of its tangible book value, the stock is priced for a high degree of success. Any stumbles in execution, missed growth targets, or margin compression could lead to a significant re-rating of the stock by the market. Investors comparing its valuation to a stalwart like Apple stock need to understand the immense execution risk that comes with a high-growth financial company. To that point, I want you to comment below what you believe SoFi's biggest challenges for the next 12 months: competition, regulation, or macroeconomic pressure. In summary, the story of SoFi is far more nuanced than the simple bull or bear case that dominates social media chatter. The expectation was, and for many still is, that SoFi is a technology company that happens to offer financial products. The reality is that it is a bank, a fully regulated depository institution that leverages technology to build its franchise. Its stock price movement reflects this fundamental tension. The closing price of $27.98 on Friday is not an endpoint, but merely a snapshot in time of a dynamic and ongoing battle. The company has a powerful brand, a growing user base, and a unique strategic position with its bank charter and technology platform. But it also faces the unforgiving realities of the credit cycle, fierce competition, and the high expectations embedded in its share price. Understanding this conflict between the popular narrative and the underlying fundamentals is the key to truly grasping what is happening with SoFi Technologies.